Hey, what's going on guys? Welcome back to another video. Today we're going to be talking about closing positions and even potentially rolling positions. This is a very important topic. It is very nuanced. There's a lot of different details in closing a position. So I'm going to go through the whole list of different strategies and when to close those positions. This is a question that I've gotten so many times. I mean, I've been asked this over and over again on YouTube. One of the issues is it's very complicated to close a position because it's not like the option goes to a 75 delta and there's a magic formula. Like boom, sell it at 75 delta or get out of the position at a 50% loss or at a 75% gain. It really depends. So I'm going to go through the list of my current positions, how I view my current positions, give you some examples, and I'm just going to briefly run through call options, put options. So buying a call, selling a call option, which is a covered call, buying a put option, selling a put option. I'm going to go over all the different spreads. So put credit spread, a call credit spread, a put debit spread, and a call debit spread. Maybe we'll even look at iron condors. I don't know. Let's just go over everything possible about closing options because this is literally something that I've been asked over and over again, and finally I'm making this video. So let's do this. All right, so the first one is buying a call option, okay? Many people have that casino mentality. They go in, they buy a call option, they start hoping that this call option is going to go to the moon. All right, I don't like that strategy, but if you're going to be buying call options, I think you really need to have a plan to exit that call option when you buy it. So for example, let's say that you buy an Apple call option at the $160 strike. Before you even get into that position, you need to see where you think the stock is going to end. Let's say you did your technical analysis and you think the stock is going to end at around $170. Well, what you should do is say Apple goes up to about $168, $169 per share. That is basically near your target price. So you want to start thinking about closing that option. And let's say that that call option is up about 150%. So let's say that you paid $800 for it and now it's currently sitting at $1,200. That's a 50% gain, and at that point I would look into closing that option. Now you can see my portfolio that I don't currently have any buying call options. I don't really prefer to buy them. I prefer to sell them. This is an example of me selling a call option, by the way. This is a position on SPY. I've sold a $470 call option. It's up about $5,000. So when I'm selling a call option now, let's go over to selling. When I'm selling a covered call, when I'm selling a call option, I always have 100 shares. So this strategy is for the portfolios that are a little bit larger. It's not a small portfolio strategy. You're going to want to stick around until I talk about spreads if you have a small portfolio. But for covered calls, essentially, I'm just selling it to create some income. And typically my goal is just to hold it until expiration, because the worst thing that can happen is the stock can go up to my strike price. So here, SPY $470 call option is way out of the money for the current SPY price. I mean, SPY is probably around 430. So I'm very out of the money. I do have about 6 weeks until expiration. I'm up 87% on this position. So this is a tricky one because there's two things that I could do. First of all, I can keep holding, collect a little bit more money with this option decaying, but a lot of people would say, hey, this option is up over 80%. Do you want to close it? Or I would close it. Well, you know, my answer to that is it is a style preference. For me, I do want to hold it a little bit longer, but at 87% profit, it is becoming very important to maybe close this position out. And the reason for it is over the next 6 weeks, I don't have that much more money to be made. So there's two things I can do, and really it's just one thing, which is roll the option, okay? I can roll down, which would mean that I would open the same date for 6/17, which is 6 weeks out, but I would roll this position down from 470 to about 460. That would reduce the strike price, which would give me a higher risk. However, I would collect more money for that new position. Now, I can also roll this position out. So rolling down would be reducing the strike price, but rolling out would be increasing the length of time or putting my expiration farther into the future. So instead of June 17, I can go for July 15 or something like that. Increasing the length of time would give me more money because, well, time is something that's really valuable in finance and investing. The more time, the more money you will get paid when you are selling options. And if you're buying options, for example, going back to a call option, if you're going to be buying a call option, the longer you go out, the more expensive it gets, because that's going to be called a leap option once it hits that 1 year mark. Now, a leap option does have many benefits because, well, you are paying a higher price. However, a leap option is over 1 year. So that stock is going to have 4 quarters or 4 times earnings. So a lot of stuff can happen. That leap option does have that priced in, but leap options are still very attractive. They're one of my very favorite strategies if I'm going to be using a buying strategy. So buying call options, you want to exit when you have a 50 to 200% gain. For selling call options, I usually go for about 100% or around this 80% mark. So I'm up about 87%. So in the Discord community, I'm probably gonna look at this option with all the guys over there and potentially roll this trade. Again, remember, closing and rolling is very nuanced. So if you ever want hands-on help, get into the Discord, which is by application only, in the link in the description. You can ask me questions anytime for closing or rolling a position. And then you can also watch me trade Mondays and Wednesdays live with all my logic, why I'm doing something, how I'm opening up a position, where I see resistance and support. And then finally, I'm closing these positions and showing you guys exactly what I'm doing. Now, the next thing is buying put options. Now, buying put options is like buying insurance. You just want to do it because you're scared of a catastrophe happening. I typically don't buy put options, but let's say that you think the market is going to crash. You can buy a put option and just hold it until your view changes on the market. I wouldn't really set any expectations for buying a put option. I wouldn't really do a 50 to 150 or 200% goal. I would just hold it as long as you are fearful and as long as you want protection in your portfolio. Now, with that being said, let's go over selling put options. As you can see in my portfolio, I sell quite a bit of put options and they do really, really well. So for example, Apple here made $115, Amazon made $1,700, Facebook $535. This is a covered call on Palantir, which I just made last week in the Discord. Tesla right here at $790. I just opened this up yesterday in the Discord. Nvidia, I mean, I have so many different positions and another Tesla position. Only position I'm really down on is Chipotle. I overheld this position. It is actually an example of why you want to close spreads pretty early when you see a profit, because I was up about 60% in this position and I didn't pay attention. I didn't close it, but I'll get into that in just a second. So selling put options are really profitable and essentially just want to hold them as long as you think the stock won't go below your strike price. And typically I am selling weekly put options. So you can see a lot of this expires this week. It's up a lot of money. I mean, about $2,000 here. And essentially I'm just going to keep holding it until I see over 80 or 85% that I may think about closing it. But if it's out of the money and it's not near the strike price, and let's say that it's Thursday, there's no need to close out this position. I'm just going to wait until Friday and let these positions expire by themselves without even closing them, so I can collect 100% of all of the premium that I sold. And that's going to be typically about 80% of the time I'm just going to let it expire, and the other 20% of the time I will close it, and I will especially close it if this option position goes against me. So for example, let's say that Apple went down to about $150, and now at $150 I wouldn't close out this put option, but I would start analyzing the stock and saying to myself, do I think it's going to fall further? Because at this point I am at risk. When the option does go into the money, let's say Apple goes down to 149, this is when I will start to think about rolling that position, and I'm going to typically roll it down. So let's say I have a 150 put option strike, well, I'm going to think about rolling it down to 145, and that's because, you know, I am sometimes using margin. I do have a lot of collateral here, but a lot of this is actually margin because I'm fully invested in Tesla, Palantir, SPY. So a lot of these options that I am selling, I am using margin. And again, for margin, I wouldn't recommend it to a beginner. I would definitely recommend you have a lot of experience, know exactly what you're doing, and use all of my rules for using margin safely. Again, I do cover that in that Discord, which is the coaching program, but I still recommend people to have at least 6 months to 1 year of profitable trading before they get into margin. That is just because margin can be very risky. But anyways, I am typically going to roll down this put option strike if it goes near or at the money. Then I'm going to think about rolling it down. But if I do have the collateral, let's say that I have $100,000 in cash and Apple goes down to $145 per share. Well, because I'm always selling put options on stocks that I like, and if I have the cash available, I'm not going to touch it. I'm just going to let it go and get assigned the shares. And at that point, I'm probably going to run the wheel strategy, which I have a video on. You can watch in the description. Now, we've talked about buying and selling calls and buying and selling puts. Let's go over spreads. Okay, so the first one is a put credit spread. Put credit spreads are fantastic. It's when you sell one put option and then you buy another put option. All right, for put credit spreads, I'm typically going to also hold them until expiration. Now, if they do go into the money, I will either roll that position or I will just close it out. Typically, I will just close it out because in a spread, it's not that much money in terms of my portfolio size. So rolling that option position is going to be a little bit expensive in terms of bid-ask spreads, right? Because you're dealing with two legs, you're dealing with two put options. So you're going to have to pay a little bit of a price for rolling that option and opening up a new one, which again deals with a bid and ask spread. And if it went down enough, I'm just going to close out the position, call it a loss, and just move on and keep trading, okay? It doesn't happen often, but it does happen maybe 1 out of 10 times. I'll just close it out, admit I'm wrong, and move on. For a call credit spread, I'm typically using it as a hedge. So in my portfolio right here, you will probably see that I have Rivian, I'm up $320 on. I'm also going to hold this until expiration. And I like holding until expiration because it's way more simple. Now, I will close out early, especially when students ask me, should I roll that position? I will take the time to show them how they can close that position, because oftentimes they want to learn how to close a position. They want it to be more profitable. But in my experience, you can only save maybe $10, $20, $30. So when the position goes against me, I'm not going to chase $30 personally, so I just close out the position. For a call credit spread, I will hold it until expiration because I'm using that call credit spread as a hedge in my portfolio. Because when you're doing a call credit spread, you're essentially negative delta, right? You're selling delta. You're expecting the market not to rise. And that's fine with me because I have so many stocks, I have so many large positions that if the market rises, my call credit spread will see a little bit of a loss. However, my portfolio is going up tremendously. So for me, it's not a problem. However, most of the time I am using the Bollinger Bands and technical analysis that I teach to sell call credit spreads, and typically they will be pretty successful. So both of these positions are pretty successful so far. Now, for buying strategies or buying spreads, for Chipotle, I bought a call debit spread at 1500, 1520. Chipotle went way above 1520. I think it was around 1560. I should have closed that position. I was up $600, but again, because I have larger positions, I didn't pay attention, kept holding that, and now I'm at a loss. So that was actually my fault. What you want to do is a combination of things. First of all, if you have a big move to the plus side and you're buying a call debit spread and you have a short-term gain, then you can actually just get rid of that position because you're long call option and the position went in your favor. Get rid of it, take your profit. Now, in the other case, let's say this position slowly moves up. So over the following weeks, continues to rise, and in Chipotle's example, let's say it goes up to $15.50 per share and you're up about $500. So for reference, I paid about $1,000 for this debit spread. So if it's up $500 and it's currently sitting at $1,500, then you do want to take profit because you're up 50%. You don't really want to push your luck because the stock is already at $15.50. It's way in the money. That's an amazing return. So I would recommend closing out that option position and just taking the profit. Now, when do I use rolling? I typically roll positions such as a covered call. I also typically roll selling put options. So I've been selling Tesla covered calls for a very long time, and I'm always rolling a covered call when it goes in or near the money. So let's say that Tesla goes up to about 1150 or even 1200. At that point, I'm going to roll this up. So I've talked about rolling down. Now I'm going to talk about rolling up. So rolling up just means that I would change this $1,200 strike price up to, let's say, $1,300 or $1,400, depending on my view on the stock. And again, it really depends on the stock. It really depends on the situation. So I can't give you a one size fits all on YouTube. And that's part of the reason why I like working with students, because every single person is going to have a customized plan for themselves. Everyone has a little bit of a different risk appetite, and there's no one size fits all in trading. Anyways, I'd love to work with you. I hope this video was very helpful, and I will see you in the next one.